housing bull market that coincides into an inflation bull market, which corresponds into a commodities bull market, then what do? You buy these assets while they're cheap. So here's how housing ties into inflation. Okay, as the volume of new housing starts increase, it's home loans times volume is money creation, because they build a new house and then someone buys the house, but they buy the house with a mortgage and the bank issues the mortgage. Okay, that mortgage didn't exist before someone bought the house. Okay, that's really important to think about. That mortgage did not exist before the person bought the house. So every time the volume of more people come into home buying years, it's going to create inflation because banks are going to be issuing new loans. Uh, and high inflation in the 1970s, high inflation in the 2000 to 2008. And notice how housing starts absolutely crashed before the great financial crisis. Okay, housing starts is a leader, uh, and the and a really good signal. Housing starts is the leader of the real economy. Okay, housing for 2005, it just nosedived all the way down. So where are we at now? We're all the way in 2025. We're consolidating, okay? We're not like we are in 2005 when housing starts was absolutely kamikaze nose diving to the ground, okay? Look at this. Look how aggressive this downtrend move is. We're just going back and forth, back and forth. Back in 2022, whenever we did see a little bit significant inflation, notice how it was teetering above this median trend line. That's very important. Every time housing starts breaks a certain trend under certain market conditions, you do see higher inflation, and this is explained because home loans times volume equals money creation. Okay, does that make sense? They build new homes, people buy the homes, but they don't. Not everyone buys a home all cash. Okay, not even most of the institutional players do that. That makes no sense. Why would you tie up all of your cash to one house? Buy a house for $400,000 and then what? Just still pay taxes and no, it doesn't make any sense. So they finance it with a mortgage, and the volume of those new mortgages coming into existence creates inflation. And this is a very important concept to grasp. Big inflation in the 1970s, big inflation in the early 2000s. There wasn't any inflation over here. Why wasn't there any inflation over here? Well, my theory is because the demographics were weak and it was a declining interest rate environment, because interest rates peaked over here, okay? This was the last leg of interest rates increasing, and that was an inflationary environment. It was the 1970s. You had big housing starts all throughout here. Interest rates peaked over here, and then from right here all the way to pretty much where we're at right now, it's been a declining interest rate environment. We're going to go over that as well, but just notice how it's all interconnected. The entire global financial system's all interconnected. Housing ties to inflation, which ties to interest rates, which ties into all the assets throughout the world. It all the currencies. It's all interconnected. Okay, and at Daley and Polk, we just look at a bunch of data to see how we can make profit off these interconnected dependencies. People are the driver. So this is what I was talking about. This is U.S. population growth per year. Okay, so as this is the rate of growth in new people being born. In the 1970s, there was a big increase. There was also a big increase from pretty much the early 1990s. Okay, so people are the driver. From the 1970s, a lot of people were being born that day. Okay, this is U.S. population growth as a percentage. Okay, a greater increase of people were being born at these times. As you can see, this is kind of a declining trend, and then a lot of people get born right here in the 1990s. Okay, so if you do like a little bit of math, think logically. When do people get ready to buy a house? Well, they get ready to buy a house whenever they're ready to have kids. They're getting married. They're at their peak financial, well, maybe not their peak financial years, but they're probably in the mid cycle of their career paths, and they're making a lot of money. Okay, people buy houses around, let's say, on average, to 30 years old. I just use 30 years old as an example to show you. Uh, from the 1970s 30 years later is the early 2000s, which, if we go back, we saw a big boom in housing starts right over here. So if someone was in the early 2000s, if they look back at the data, they could have potentially predicted a big housing boom market because a large demographic was potentially coming into home buying years. That's exactly what's going on right now. People that were born in the 1990s are in their home buying years right now. And there's a lot of implications for that because demographics are the people that buy the homes. You are the driver. Whenever you go to a bank and you're ready to buy a house, you talk to a loan officer and you buy a $400,000 house and your mortgage is like $350,000 at a 5% interest rate. That loan officer, whenever they wrote those contracts and issued the underwriting and blah blah blah, whenever they did all that boring paperwork, they just created money. That's essentially what they did. Whenever you go to a bank and you do that they created money. It's the issuance of loans that creates money. So you and the demographics of all of viewers watching and throughout the entire world uh, really are the deepest derivative of money creation, uh, which is really profound whenever you think about it, because that means uh, at the deepest root, what is money? So we looked at the demographics. In the 1970s to the 1990s, there was a big growth in people being born. Uh, let's look at housing inventory, okay? We're in 2025. We're at like no housing inventory, okay? If you're looking to buy a house right now and you're like, why are home prices so high? And well, why can't I buy a house? And every time I look on the market, it's gone like throughout a week. I don't even get time to get my loan officer ready to put in the paperwork. So taking a look at housing inventory, we're just under 1.8 thousand homes essentially on the market per month. Okay, this is terrible. We're at like record lows. I mean, the only time it was lower there was during 2022 and like since COVID, pretty much. But there's no homes on the market. Okay, if inflation's getting sticky right now, if we're at like kind of stuck at 3 to 4% inflation with no homes on the market, and we know based on the data that we've looked at that housing creates inflation, then let's say this mean reverts, it just goes to its average around 2.4 thousand homes on the market. That means that we should expect a lot more inflation in the future because we're going to need to build a lot more homes that causes that inflation. Okay, because we're going to be printing more money relative to there are things to purchase, and that's how inflation starts. So yeah, housing inventory is in the breakout of a multi-decade declining trend. There's been a big underinvestment. Big underinvestment. Another thing about housing inventory is the massive underinvestment since the Great Financial Crisis. So whenever the real estate market blew up in 2008, a lot of these home builders went bankrupt. Most of them went bankrupt, and the demographics were terrible for home building. So they all went bankrupt, and there wasn't any demand for housing in the first place. So the real estate companies that did exist they weren't that profitable at all. That mass underinvestment cycle, really since, I mean, it's been 15 years. Real estate has been underinvested in real estate building companies for 15 years. Okay, 15 years. We've been in a 15-year decline in investment for real estate companies. Okay, and we're just on the breakout of home inventory. Look at this. If I would have drew a line right here, if I drew a straight line from what is that, 2006 to where we're at right now, you would see that it broke out probably last year and not last year, but early 2025. Okay, it broke out. It did a retest, and now it looks like we're in an uptrend, a short-term uptrend for real estate inventory. So what does that mean? A short-term uptrend in real estate inventory. We're building more houses. We need to build more houses because we already looked at the data. In 1990, there was a lot of people, the millennials, that were born, and now they're in their home buying years when there's no inventory on the market. It's not a real estate bubble. Homes prices aren't so high because they're in a real estate bubble. It's because we're in a real estate shortage. Okay, there's no homes available. There's no homes. We're actually there's around 1.7 thousand uh, per month on the market, but so that's the point. Okay, there's no homes available on the market, and it's very important. So I had my quant rents and data. A 1% increase in the M2 money supply is around a 0.43% increase in CPI inflation, and that means that money creation and CPI inflation is positively correlated. Whenever you print more money, inflation goes up. It's quite obvious, but it's if you look at the money creation that occurs now, it's very saddening because the government spends more than it makes. Okay, so if you look at this chart right here, right now around it's around a 1.8 trillion dollar deficit around COVID. Golly, guys, we ran a $3 trillion deficit. Okay, imagine you went and spent $3 trillion over your spending limit, and then you robbed everyone else to pay it back just for one more year. That's literally what the government does every single year. Well, I mean, it was only down 3 trillion one time. Blows me, Let's see how many times it happens again. Okay, I would like to bet some money from someone with that. Uh, but we're starting to run $1 trillion deficits casually, and that's terrible because we print the difference and we get taxed to actually fund their deficit spending. It's actually ridiculous. Okay, it's actually ridiculous. They take our money, they take your paycheck, and then they spend it on their stupid projects, and then they spend the rest on the military, and then maybe some on their interest payments on the debt. Okay, so I mean, America, they're maybe I should learn some investing from them. I'll just say that it's a cycle of defeat because look at look at the aggression as this goes lower. You know, eventually we never ran too many deficits. It didn't really happen, um, but now it's just became too much. So the cost of money. So now we're looking at U.S. government yields. Okay, this is very important. Yields are the cost of money. Okay, because we know inflation is caused by money creation, and we know that money creation is loan issuance and money being lent into existence. Therefore, there's a dollar due on every there's interest due on every dollar in existence. Okay, there's debt for every dollar in existence when you really think about it. Uh, 'Cause all money is loans being issued into existence via an IOU. You're borrowing that money. You have to pay that back. Okay. In the global financial world, money is lent into existence. So there's interest due on every dollar. Okay. So yes, interest rates are the cost of money, which are the interest due on dollars, which is essentially debt. Okay. So for decades of easy monetary policy, it really changes asset prices and the way people think about money because year in year on end they expect the price of money to decrease. They expect money to get cheaper, and when something's cheaper, the supply demand dynamics of that means that it's essentially more abundant. So there's an abundance of money, and that creates bubbles. Okay, that's very important. Lower your yields over extended periods of time, of course it's going to create a bubble because we went from, as you look on the chart, essentially 16% yields to zero. In COVID we had zero yields. In some European countries there was negative yields. In Japan they're running I don't even think their interest rates is it's even 0.5% yet. Okay, interest rates are still extremely low, historically low, mind-boggling low. Even though we've had a short come up since 2020, interest rates went to zero, guys. Remember that. Oil went to zero as well. We're not going to talk about that in this video, but oil is a really good opportunity as well. Um, but as you see, I talked about ever since 2020. But this chart goes from this is 1980 and this is 2020, and this is where we're at right now. So we recently broke above this trend line around 2024. And this matters because bond prices and bond yields are inversely correlated. So, as we just looked at over here, these are yields going down. Yes, so yes, U.S. Government bonds 10 years. Yields going down means bond prices were going up. Okay, yields going down meant bond prices were going up. Now we're in the beginning of an increase in yields. So by the concept of bonds, therefore bonds should be going down. And if we look at some data, bonds were down 40% since COVID. Okay, so right here, this is a bubble. Bonds were in a bubble, and the markets finally realized it. That's what it really comes down to. Okay, because this move right here, this increase since 2000 from 2020, 2020, 2000 to 2020. That's the last leg of the decrease in yields as we look in this chart right here. 2000 to 2020, that was the end of the bond rally. Okay, bonds capitulated to the upside, which I mean, I don't think that by definition things can't capitulate to the upside. It's a blow off top. Okay, from 2000 to 2020, there's a blow off top in bonds because yields entered its final phase in the decreasing. Okay, so yields went down, bond prices blew up to the upside, and as now yields went up, we're having a 40% decrease in bonds. All right, so and if we think that housing starts based on the demographics are going to increase and that's going to cause inflation and inflation causes yields to go up, then these bond prices have to continue to the downside. They don't have to go straight down, guys. They can it can go down and then go back up and then go back down. They go back up one more time and then really go back down. It can do whatever it wants, okay? But it's definitely not going to do what it did right here. That's all I'm saying. Yeah, this matters because the first time in a half century, the bond markets really started to begin cracking. The government bond market started to begin cracking. And it was simultaneously as the cost of money increased. So there's obviously a positive correlation in there. I had my quant run the numbers, and if you just look at this chart, I didn't get this chart from my quant. I got this from TD Toronto. So, but yes, bond yields go down, bond prices go up, vice versa. And this matters because if the inflation rate is greater than the yield on the bond, you're guaranteed to lose money. Okay, so let's say inflation's at 5%, and I'm holding bonds, and I know that they're gonna give me a 2% yield every single year. And inflation's at 5%, I lost 3% of purchasing power per year. My bonds decreased in the value of the currency by 3% each year. And that also causes people to sell bonds. All right, because if inflation, let's say inflation is at 15% and you're holding a 2% bond that pays 2% interest per year, you're going to dump all of it. You need to liquidate to chase other assets. I mean, you're just losing a bunch of money, and everyone's going to eventually realize that that's a lot more likely and possible than they ever imagined. So I mean, you just got to be patient, at least in my opinion. You just look at a bunch of data, just be patient, and look at these really big long-term trend lines. And so this is stocks relative to silver. Notice how in the early 2000s, from 1980 to the early 2000s, it was a massive SPX silver bull market. So stocks really outperformed silver. This is analogous of the declining interest rate environment. And then from 2000 to 2008, that's when housing starts to begin to break above that long-term trend line. Housing starts broke over here. They pulled back. This is the tech bubble. There's always some type of technology, not always, but there's usually some sort of event, right, before these big commodity bull markets. In 1971, it was them taking the dollar from the gold standard to fiat, and in 2000 it was essentially the technology bubble, and now I would say it's kind of been COVID and these wars going on. To go back to the main point, stocks are looking extremely overvalued. The only times they were this pricey was during one of the largest technology bubbles of all time. And I think we're in a bubble right now. I call this the AI bubble. It's as simple as that. AI actually consumes a lot of electricity that no one really likes to talk about. Let's say if it takes some of the supply from what's already a scarce asset, and the money flows aren't there yet, things can really start depleting really fast. Natural gas can start depleting really fast. Oil can start depleting really fast. And during increasing interest rate environments and high inflation, well, there's high inflation, there's increasing interest rates because there's higher inflation, okay? Because there's new home loans being put uh, on the market, there's new money being created, okay? And whatever there's new money being created, it causes inflation, and silver and these hard assets begin to go up. So that's why you look at from the early 2000s to 2011 commodity bull market, uh, housing loans bull market, and a bust. It benefited from the boom and the bust of the housing market from an expansion phase. It benefited the entire expansion phase. In the early 1970s to 1980, housing bull market, there was a supply crunch as well. But yeah, guys, this is a really long-term trend line. From 1890 to 2025, there's only been one time silver's ever been this cheap relative to stocks. Okay? And guys, guess what? Silver's breaking all-time highs. So what does that say? If silver's breaking all-time highs, while it's only been cheap a couple of times ever to stocks, and it looks like we may be in the beginning of a housing bull market that coincides into an inflation bull market, which corresponds into a commodities bull market, then what do? You buy these assets while they're cheap, and then you just hold, and you just hold longer, and you maybe sell whenever the ratios flip. Like if you buy silver in 2000, sell your silver for stocks, or let's say some like really leveraged technology stocks like Tesla and Nvidia and those type of stocks in 2011, and then you hold, and then as you see it begins to break out, you flip your stocks back into silver. Silver right here, silver right here. Technology stocks right here, technology stocks right here. You see, in the 1970s, big housing boom. Inflation goes up, silver goes up, and stocks go down. During high inflation, high interest rate environments, money rotates from stocks to hard assets as shown in this graph. Because at the lower end of this blue trend line, these are really low valuations relative to these extremities over here and even over here. These are like, this is the cycle, or at least this was the cycle until mass money creation makes this blow off. But all of these are going to go up. What this means is silver's going to go up a lot more faster. That's really what it means. Simple as that. These are money market funds, so people sell their stocks and bonds, and they really sell anything, and they park into money market mutual funds, and it's like 1 month, 3 month, 6 month treasury bills, really short term cash instruments, and gold as well, because those are safe haven assets. Like I said, silver's breaking all time high. You better have known that gold's been breaking all time highs, and it looks like it's going vertical. Gold looks really good. But silver to gold ratio is at all time lows. So what does that mean? That means silver's dirt cheap. If silver's at all time lows relative to gold, it's at historic lows relative to stocks, and it's breaking all time highs priced in dollars, and we know dollars are going down, then what do? You just buy silver. You just shut up, you buy silver, and then you buy some more silver. It's as simple as that. So what I'm getting at is we're in the beginning of a really big commodities bull market. Today was just an introduction on some of the data I look at to navigate where we are in cycles and how do I identify asset classes that I think are going to go up, and I use that by looking at yields, demographics, and inflation, and a lots of other data as well. But I'm only going to go over that right now. So to summarize what I really went over in this video, this is a once in a generational opportunity, guys. Okay, commodities are at all-time low valuations across pretty much everything. So we looked at silver to stocks and gold. Silver's at all-time low lows relative to gold. It's really low against stocks. The entire commodity looks like that. Commodities are undervalued relative to every single other asset. Yet this year, uh, they seem to be outperforming everything. Okay, they are orders of magnitude cheaper than every other asset on the market. Yet, if commodity does a 50% increase, like it'll it'll be like nothing. Okay, nothing. It's like trying to pour an ocean in a hot tub. Okay, that's what commodities are. Commodities are the hot tub. The ocean is money flows, and let's say the entire Earth is like all the other assets. Okay, that's what's happening. Commodities are really small. All these other asset classes are super inflated because we've been in a 40-year declining yield environment. Interest rates have been going down for 40 years, and that cheap, easy money policy creates bubbles like crypto and the great financial crisis and AI valuation bubbles going on right now, and NFTs, and I wonder what else I'm missing. Looking back at this, I'm probably going to figure out like five other bubbles that I'm missing. But all this cheap money, it changed investors' psychology and uh, the economics of the market, and now they're reversing. We're in a paradigm shift where inflation's going up and interest rates are going to climb higher. And a big demographic of people are coming into home buying years. Every single time throughout history, this is corresponded in a great commodity bull market. And this time is no different from any other time in the past. I would compare this to like, I would say this is like the 1970s, but instead of maybe just America, it's the entire West or the entire world. Like, I think this could get kind of freaky. I think this could get, I don't know, and it's kind of scary too. It's really scary because what does this mean? Well, this means our dollar is going to fall off of a cliff, and it means a lot of people are going to get a lot poorer than they ever thought they would ever be. It looks like the middle class can get wiped off the face of the earth in America because they will have no purchasing power. I think that's really dangerous. You could see really violent things happen if middle class America simply can't afford to live because the government just print all their money away. You can, if they've been doing some weird things and like, I don't know. Okay, it's just my brain. I'm just sharing thoughts. Um, but just based on how the world's working, we're kind of divided right now. Making everyone's pockets poorer isn't going to make anything better. Okay, it's just going to piss everyone off even more. It's going to be poking the bear, but the bear's like wide awake. Yeah, this is Javier. Thank you for watching, and yeah, subscribe, like, and I'll see you at another video.